Look, the Chinese government have been very supportive of coal-bed methane since I got there in the mid-90s. And I think all we're seeing here in 2017 is more of the same. So they've been consistent with their support for the obvious reasons. Coal-bed methane is the single largest domestic energy resource that China has. And clearly what China will do is put that on stream. And what that means for Green Dragon is that we've gone 20 years developing an asset because of their government support. Most recently, a year ago, the government doubled the subsidy that it was providing on every molecule of gas that we sell. And we see that being stable going forward. So what it means for Green Dragon Gas ultimately is a stable government, sustainable subsidies through contract expiry, which is another 25 plus years, and our consistency in continuing to develop coal-bed methane domestically in China. So I think first in CapEx, the ODP plan's been approved for our GCZ block. Net to our interest, that's about $25 million that we will spend over the next 18 months. So not 17, but 17 and 18. We'll drill about 147 wells doing that. So that's GCZ. On GSS, our second commercial block, we need to drill approximately 75 new Le Fabric wells. That's again over 17 and 18. The total CapEx is about $116 million. That delivers the 1P resource net to our interest of about $1.3 billion. That's the total spend for 1P over the next 18 months. And that's what we're targeting to spend through the end of 2018. We will certainly not look at equity for Green Dragon Gas. We might look at equity for subsidiaries of GDG, but certainly not GDG. The company is in a very good place today. We've got 4 different term sheets. Each term sheet provides us a different option. And I think in our results that we published yesterday, we identified that we are considering a Hong Kong listing for a subset of our assets. We have options on reserve-based loan. These are Chinese banks. In the Western world, we call it a reserve-based loan. The Chinese may call it a bit more project finance loan versus just a traditional RBL. And those options are very much available to us. So at this stage, the board and the company are working through the path that we wish to follow, not for the short term, but for the longer term on the development of the production assets. So we'll have those decisions out within the next month. So by the end of May, we will be quite clear about which of the options we have elected to exercise on. So the downstream assets that were developed for the right reason when we launched it about 4 years ago was to avoid captive gas or stranded gas. It provided us an avenue to take our gas to market. What's essentially happened about almost a year and a half ago, the government released Downstream to market. So there's no longer a monopoly in pipelines that are built around our asset. So the value proposition for Green Dragon Gas is gone, hence a non-core asset that should be sold. Our total investment into that asset is roughly $15 million US, and we reckon that we'll certainly sell it for at least that as we exit. Timing, we want to sell it by the end of this quarter. So our objective is to get the supplementary agreements done this quarter. We should have actually got that done already. We're waiting for one opinion, specifically a tax opinion, to come in. And once we get that tax opinion, we'll get the supplementary agreements signed and closed. With that closed, the ODP has been in concurrent development. So this is not a sequential event. The guys on the ground have been working through the ODP for GSS. Once these supplementary agreements are done this quarter, we're certainly comfortable that we'll file the ODP for GSS prior to the end of the year. So during the second half of 2017, we should get that done. So the increase in GSS gas sales is purely infrastructure. We've got about 1,500 odd wells drilled, less than 10% of currently selling gas, and we're developing compression technologies at the wellhead that create vacuum at the well so we can suck the gas out of the well, if you will, or out of the coal seams and shove it down the pipeline. The entire 34% increase that we had in gas sales is purely compression driven. We certainly didn't drill any wells in 16, so this was all driven from just pure infrastructure coming on stream. And that's literally 10% of the total wells in the ground. So the same success that we had on the 10%, we should have on the balance 90% in due course.